The decision is in, and the Federal Reserve has raised their Fed funds rate by the largest increase in 20 years, and they've signaled they're not prepared to take it to the next level. Will it be enough to rein in inflation? And what does this current rate path mean for mortgage rates and the housing market? We'll be covering all that in today's video. Let's get into it. The Federal Reserve has made it official. They raised their Fed funds rate by 0.5 percentage point, which was the largest single increase in the last 2 decades. This didn't come as much of a surprise, however. Most people expected this course of action, as Fed Chairman Powell pretty much telegraphed this move not too long ago. The bigger news, in my opinion, is what Chairman Powell had to say at the press conference after the Fed issued their official statement. Powell emphasized the Fed's seriousness about bringing down inflation, and he acknowledged the pain that it's causing American households with these price increases, but said that a 75 basis point increase in the future is not something the Fed is actively considering. What this means is that we can expect the Fed to increase their Fed funds rate by 50 basis points at each of the remaining 5 meetings in 2022, unless something changes with the course of inflation, such as it getting much worse or starting to trend lower. Now, the real question here is whether 50 basis point increases at each meeting is going to be enough to bring inflation down. My answer to that question in the past has leaned towards no, and I cited the example of Fed action in 1980 when we had the worst inflation in the U.S. recorded in modern times. But what about all the other times inflation was higher than average? Let's look at a chart of inflation and the Fed funds rate going back to 1954 to get a more comprehensive picture to see if we can get closer to a more definitive answer. You can see in this chart here that there has almost never been a time when inflation has spiked to elevated levels without an accompanying spike in the Fed funds rate to bring it down. It wasn't just this worst case period in the 80s. We can see it in the 70s. And in the 90s, the Fed funds rate was consistently higher and seemed to keep it down for the decades following it. Without doing any calculations, you can already see that throughout history, the Fed funds rate in general has been higher than the rate of inflation. And look where we are now. Inflation as measured by the CPI is going parabolic. And if history is any lesson, I don't see how this is going to come back down unless the Fed gets more serious than 50 basis points in their future increases. So we have this graphical analysis showing us the Fed funds rate has pretty much always had to rise close to or higher than the rate of inflation whenever it gets higher than average. And now we find ourselves at a time when inflation is definitely elevated and the Fed funds rate, even with the most recent increase, is further below the rate of inflation that we've seen in data going back to 1954. So will the Fed need to get more aggressive to rein in inflation? I'll let you be the judge of that. But in my opinion, 70 years worth of data suggests to me that for the Fed to achieve the infamous soft landing where they can rein in inflation with minimal rate hikes and messaging and not crash the stock market, housing market, and overall economy, it would take nothing short of a miracle. We'll see how this plays out, but I think you know where I stand on the issue. Now, let's get to what this means for mortgage rates and the housing market. For those of you that have been watching my videos, you know that I've mapped out this scenario where the Fed raises rates by just 50 basis points for their remaining meetings in 2022. What I found is that this will push mortgage rates up to 5.6% by the end of the year. But the way the market is pricing in Fed's anticipated actions, it's likely to get there well before the end of the year. This higher mortgage rate will then make homes so unaffordable prices will have to come back down. And by my estimates, that will be in the range of a 9.5% pullback by the end of the year for this scenario. So what do you think? Is the Fed going to pull off the infamous soft landing, or will they have to get really aggressive to rein in the highest inflation in over 40 years? Let me know in the comment section below what you think. Next week, we're going to get new data on the Consumer Price Index and Producer Price Index, giving us a critical update on the latest inflation numbers. And we also have new real estate market data in, so I'll be releasing an update for my housing market crash scenario soon after those data releases. Make sure you're subscribed. Hit that notification bell down below so you know right away when that video comes out, so you can see how far away we are from a potential housing market crash and by how much. If you've enjoyed this video, please give it a thumbs up and share it with others to support the channel and help it grow so I can continue to bring this content to you. Thanks for stopping by, and I'll see you in the next video.